Welcome to the Matter Financial Report. I'm your co-host, Tony Shore. I'm here with our host, the man with the plan, Michael Matter. Michael, thank you for having me on the show today. And Michael, I am so excited about our show today because you really know how to pull strings. What a huge get. We have a guest on the show today. This is a big get for the show. We are sitting here with the one, the only Ernesto, and Ernesto De La Torre.
Yep,
Did I get it right?
You got it.
I rolled the R's.
That's impressive.
Yep. And Ernesto's visiting from Gradient Investments, right?
That's correct. I'm an investment consultant at Gradient Investments. Been there 6 years, and I've been working with Michael a number of those as well. So excited to be on the show. Thank you so much for having me.
How did you pull this off, Michael?
It's been a while coming. It's been about 2 months. Ernesto said, "Hey, I love your podcast. Let me get on this thing."
Yeah.
So I don't know if you're ready for the big time, Ernesto. Let's play this slow, slow the roll. But no, I'm just kidding. Ernesto is a great partner for my company. Gradient Investments has been amazing. So that's something that we're going to talk about today that makes our company, the Matter Financial Group, a little bit different than most other advisors. The partnership that I have with Luson, Tony, your company, Gradient Investments, Gradient Advisors, Schwab. Those are, the background companies that my clients don't really get to see on a day-to-day basis. But when I'm working on their accounts, I'm calling Ernesto at, I don't know how many times a day, Ernesto.
Multiple.
Pretty frequently.
Yeah.
Right. And so he helps me put those reports together that we always talk about, investment recommendations. And when I have questions about where the market's heading, he's a sounding board on, where his thoughts are on the portfolios and recommendations.
Yeah. Well, and that's actually exactly, what I thought the timing was kind of perfect of you inviting me onto the show because, kind of wrapping up 2025 here, looking at 2026, I'm excited to kind of recap what we've seen so far this year and what we can, look forward to in the next year. But like you highlighted, Michael, our partnership with your firm and Gradient Investments, is very different than a lot of other advisory firms because you have, one thing I'll say is it's direct access to the portfolio management team. Your clients have direct access to the portfolio management team, certified financial planners as well. So that's a big differentiator because, if you try calling a 1-800 number for another firm and asking to get their portfolio manager, you might not get very far.
That's true.
I actually highlighted that with a client just yesterday. We're talking about the different portfolios that Gradient Investments provides for my firm. And I told him, I've worked at other companies before. I worked at Chase, I worked at Prudential and Mutual of Omaha before I started my own company and partnered with Gradient. But, BlackRock, other companies, JP Morgan, Chase, Wells Fargo, I said, go talk to them. See if you can get a portfolio manager on the line and explain their investment decisions and their actual, why they're making the decisions inside the portfolio and see if they'll actually take that call. I don't think that they will, just like you highlighted. But with Gradient, I know the portfolio managers, and you will get on the line with my clients and discuss the specific portfolio. And if they have objections to maybe one investment choice inside that portfolio, we can, make some tweaks and tailor that portfolio more to our clients.
That's exactly right. It's kind of the big role. And what I love about working with you, Michael, is, I am very much in the background, but you can't really put a number of how many hours it takes to, do all of the work for building a client's financial plan, selecting their investments, because, no one plan is the same, right? Everybody has a different situation, different risk tolerance, different investment objectives, goals, so forth. So, very much, there's a lot of thought that goes into it, to say the very least.
Yeah. And to just piggyback off of that, that's another conversation that I have with all of my clients is we don't really, we can meet with clients that already have other advisors. I'm not really there to build a wedge between you and your current advisors. I'm just there to show you how I probably work with you differently than your current advisor. and that is making sure that your goals are being met. It's not a cookie cutter situation. It's not, everyone comes in, you get a 60-40 portfolio. It's really tailored to your risk tolerance and your specific needs.
Yep.
And Gradient Advisors and Investments helps me put those reports together and to individualize every report.
Well, and I also see, there's a lot of individuals that like to do it all themselves. There's a lot of what you might say DIY, right?
Yep.
YouTube University helps them. Hey, or nowadays with Reels, you can just kind of scroll and find all sorts of things. But there's actually one image I'd like to pull up here if you can, Tony.
Sure.
It shows the average return for your DIY investor. It's just actually the one.
Is it?
It's got the different asset
but this one actually
the performance.
This one highlights something good that I did want to bring up. So actually, yeah, I'm glad you pulled this up here, Tony.
This is the average investor return right here.
No,
it was a different one, but this one, this one will work just fine for this point.
Or would you rather have that one?
There we go. Yep. This is the one we were looking for. Yep. Because, everybody wants to buy low and sell high, right? Which sounds very easy to do, but in reality, it's not at all, because then you're talking about timing the market. And not only are you timing it once on when to buy in, but then you got to time it again on when to get out. And so most people, especially with all of our emotions, it's really hard to, especially when, things are red, and the market's going down. It's hard to pull the trigger to buy then, or, not sell and stick with the plan, focus on the long term. So I like this image because it shows, the S&P average return of, 7, 8, 9.5 here. Depends on how you want to adjust for inflation, but the average investor gets about 3.8. And why might that be then?
Yikes.
Tony? Yeah.
Yikes. Yeah. Well, it's because the average investor, the DIYer especially, who invests in stocks, they let emotions play a part.
Yep.
And so what they end up doing, in fact, the majority, I've read the majority, a large percentage of people who invest end up buying high and selling low. And that's exactly why their earnings over those 20 years right there, or 19 years, were 3.5% versus the actual S&P did 9.5. That's a huge difference.
It's a big difference.
Yeah, and if you're not working with a professional and you're a DIYer, I haven't heard this term before, Ernesto, and I love it. YouTube University. Hopefully you're watching. Hopefully we're a part of your new university, because we're on YouTube right now. So I guess we're part of that university.
Sure.
But the information that you're getting, if you're trying to do it on your own and you're getting it from influencers or advisors that have a podcast or they're putting information out, the market has already built in the information they're giving to you. So if you're trying to time it, the market's already built in the timing. So you're never going to be able to do it. And that's why you see that number at 3.6 instead of 9.5% compared to just the S&P.
The average investor is barely staying ahead of inflation at this point.
That's exactly right.
So if you think you're going to time the market by some information you got off of Instagram or Facebook, you've already missed the boat, and you're going to be at the wrong end of that swing, right? And so that's why I think you see these numbers differently. So working with the professional, an advisor, if you're fee adverse and that's why you think you can do it better yourself, well, this chart proves out that, paying a fee, having a professional do it for you, at least giving you advice and holding your hand and giving you an explanation as to why you're invested in what you're invested in.
Well, and I look at it like, you might be handy and know how to fix a couple things at home, but you're not going to build your entire house, right? You need a team to help you with that. You need specialists like electricians. Those can be your portfolio managers. You need framers. Those can be your certified financial planners. And Tony, if you do pull up the other PDF, the last one you had up that shows corrections happen every year.
Is that this one?
The next one there, the red one.
Oh, the red one.
Yep. There we go.
There we go. We got a lot of PDFs here.
Just
we do.
I should have put them in order. Yeah.
Yeah, no worries.
Show prep.
But on that topic of, emotions, timing the market, it's near impossible. And we don't even practice that at all or preach it. Rather than timing the market, it's better to have time in the market, right? So that things like this, like you can see here with this PDF, corrections do happen every year. Talking about this year, 2025, we all remember April was a pretty volatile year in the market. We were down, about 14, 15%. And then, a couple months later, we're back to even, and now even higher. Since that trough to the peak, it was actually about 40% of a rally. And so if you're trying to do it yourself and navigating these, volatile markets at times, it can be, very, very hard to do. And so rather than doing it on your own, have a professional watching this for you and having time in the market.
Yeah, what is this chart actually showing us? This S&P 500 performance. Obviously, above zero, those are the profits it made. And then it shows the losses. Is that right?
Yep. So this is comparing calendar year returns with intra-year troughs. So dips in the market at the lowest point throughout the year to the final calendar year return.
Yeah. So all of the reds are the end of the year results. The gray are the inside of that year, the downturns on top of the end of the year being positive. So like if you go back to just last year, a 19% dip in the market at one point during the year, but it's still end of the year positive 16%.
Ah, okay. Sure.
And I just want to go back to that DIYer. I think most people do a really good job at saving for retirement in their 401k, and they don't realize they're investing probably the best way to do it. It's called dollar cost averaging.
Yeah.
And so they don't even know. Half of my clients don't know what they're invested in. It's usually like a target date fund with their 401k. It's just a blend of equities and bonds. And the closer you get to retirement age, it shifts more towards bonds, less in equities. They're taking the risk off the board for you, but you don't know what you're invested in. But a little piece of your paycheck every single month is being invested for you over time. So you're not timing the market. You're just every paycheck, a portion of it goes into the market, whatever the market's doing at that time.
So you're dollar cost averaging. So then when you look at this chart, you're buying, you end up buying more when it's down than when it's up. You're spending more of your money is spent better over time, right? That's what dollar
you're not
cost
trying to
averaging.
time the market. So if the market's up, you're still buying, but if the market's down, you're not consciously trying to time the market. It's just over time.
But you're putting the same amount in, so you're buying more low than you are high.
Yeah,
I mean that's good.
Right? What works so well about those too is that you set it and forget it, Tony. Right? I mean, Michael, you're not playing with it, you're not touching it, you're not using it until retirement. So you're keeping that horizon.
You don't need to worry about what the market did between yesterday and today.
That's exactly right.
Or within the week. You're dollar cost averaging your way in over the course of your working years, and really relying on that compounding interest, which is huge, right?
That's right.
Yeah.
And so that works very well in the accumulation phase, right? And then when you get to the retirement phase of your life and, you no longer are getting that paycheck every 2 weeks from working, you have this lump sum of money that you need to turn into income. That's when we really, dive in and can get pretty unique with lowering the risk, right? Because you don't want to be taking the same amount of risk as you were when you were, 20, 30 years ago, right? I mean, my kids are invested very differently than I am or than we might be.
Sure. Yeah. And a lot of people don't understand the value of continually on a regular basis buying into the market or adding to their investment funds because, again, I didn't realize, I never understood, well, how, if the market's up a lot and I'm buying, then I'm buying when it's high. I shouldn't do that. But you're putting the same amount in every 2 weeks. Let's say you put $500 in through your employer plan. Well, that $500, if you're spending $500 when the market is up, you're buying less at a higher rate. But when the market's down, that 500 is buying more of that stock.
That's right.
And so over the long term, that can really be a big benefit, right?
Yep. And that's actually, it's like if your favorite store has a 15% sale, right? I mean,
right.
Buying when the market is down is a good opportunity.
Yeah. It's great. So what's next, Michael? What else do we need to talk to Ernesto about since we've got him here?
Well, like he mentioned at the beginning, it's the end of 2025. So this is our last show for the year, right, Tony? And
Yep.
we're gonna miss the first week because we're gonna be in sunny Arizona, enjoying the
Yeah.
weather. So before we get into next year, a lot of my clients are asking, what's the outlook moving forward? What's our forecast? And so, I have an idea of where I think the market's going to go and the reasons why I think that. But on top of that, Ernesto said you have CFAs and with gradient investments that are prognosticating out 12 to 24 months every single day. That's their job when they're building these portfolios and managing the portfolios. They're looking at the fundamentals of the individual stocks to kind of find out what's driving the market and what is their expectation. So, Ernesto, if you want to kind of talk about where gradient investments forecast at least the next 12 months.
Yeah, well, and you highlighted that very well, that we are fundamental investors first, right? We look at the health of the specific companies that we're buying, before considering all the noise that's out there, right? Because bad years in the market are going to make headlines. There's always going to be something on the news. There's always going to be a concern. But when we're investing in solid fundamental, that have good fundamental companies, then you're poised for success, right? So looking ahead, I actually did bring up another PDF here, Tony, if you want to show that. What Wall Street is forecasting modest returns in 2026. So, corporate earnings were projected at about 10% in 2025, and we got a positive year in the market of, well, we're nearing the end here with about 14.5%. 2026, they're forecasting corporate earnings to be about 13% with a market growth of 6, 7, 8, which I'm kind of right in that camp. I like to be very modest. I'm very optimistic overall, but I don't want to shoot for the stars, right? I like to under promise and over deliver. I've heard you say that many times on the show.
Yes.
So I like that, but keeping a realistic outlook and being able to move with the price target, right? Because there can be things that evolve throughout the year and the start of 2026 that can change that price target. But I think a modest high single digit return would be great. Yeah.
Yeah, and that's why I love our conversations, Ernesto, is that we don't always have the same viewpoint of what's going to spur the economy and the growth and the certain companies that we like to talk about and Bitcoin and what's going on with that and what should we be invested in. And that's great to always have not just the same voice or same opinion on everything, and to come with facts that Gradient Investments always has a reason behind their recommendations, and mine just might be an opinion. So, right, marrying the two and my research and your research and just coming to the right conclusion for my clients. But also on top of that, Gradient Investments has so many different investment choices. So if the market, if we have a client that's really bullish on the market, even more so than you and I, then we have an investment that will match that risk tolerance and enthusiasm for the market. And if someone, you and I both think that it'll be a good, there's good foundation for a good next 12 months. And that's my expectation as well. But if someone's negative, we also have investments that are going to cover. They either offer a 100% buffer to the downside, or they can take some risk off the board. And if the market's down, they still have a return. So we have investments that cover, whatever your risk tolerance is or thought on the market, we have an investment choice for you.
Yeah, that's exactly right, and well said.
Thank you.
A variety of having there's no one flavor, right? There's no one size fits all. You need to meet with Michael. Take a color of money risk analysis to start. Get a range of what you're comfortable with, risk wise, so that when because it's not a matter of if, it's a matter of when we will have another down year, right? But so being set up for that, we have buffered strategies, for example, with different adjustments for risk. If somebody's very conservative in retirement, we can protect against that downside. If somebody's very growth oriented, like you said, Michael, we can tailor to that as well. But those buffered strategies do a very good job of mitigating the downside risk for, again, when we have a down market.
So if you're interested in looking at what it looks like to put a report together, not with just myself and my firm, but now you've seen the other side with Gradient Investments and Advisory, who's helping me put these reports together. The bottom of our scroll here is the Matter Financial Group. Go online. There's a new Calendly link, so you can actually select a time that works for you without even contacting us. Or you can give us a call, 916-469-9016, and we'll put you on the calendar.
Yeah, that sounds great. Hey, I want to ask, before we let him go, Ernesto, what's this?
So this PDF, actually one of my favorites, does a
Yes,
really
me
good
too.
job of highlighting the odds of being positive, as you can see. So
Okay.
the right side of the screen shows all of the calendar year returns that the market has been positive since 1926 to 2024. About 73.5% of those years have had a positive return in the market. So, on the left side, the down years in the market, that's what we want to, use buffered strategies or insurance strategies, a variety of things to mitigate that left side. But I mean, this keeps me very optimistic right here.
Yeah.
Ernesto, and I want to build on top of that. If you look at the chart and you see the double-digit growth on the right-hand side, there's so many more 10, 20, and 30-year growth that you don't see on the left-hand side of 10, 20, 30-year or
Oh,
20,
yeah.
10, 20, 30% downside. So compounding those 20 to 30-year percent growth, if you think the market's not for you, this is the chart that I like to show my clients that think that they really are conservative. They don't want to be in the market. It's like, let's do a risk analysis. Let me show you some investment choices that might actually fit your tolerance. And then let's look at this odds of being positive chart. And people are really surprised when they see it. They're a lot more negative on the market until they see this and they realize, you know what? I probably should at least have some skin in the game. This is proving it out that, this is a reason for me to take on that mitigated risk so that I can participate on that right-hand side of the chart.
Yeah, I mean, you can almost count on one hand the number of years in the past. How many years is this based on?
98.
1926
just
to
about
24.
98 years.
Now, in the last 98 years, you can count on almost one hand the number of years the market went below 20. I mean,
Yes.
that's unbelievable. Of course, one of those years was 2008, and that's still fresh in some people's minds, even though it's been a while. And the last time we had a negative year was 2022, 3, 4, and 5, huge years.
Huge years.
I
Yep.
mean,
Yeah.
and then a couple years before that, before 22 was up. So it is interesting to look at this and to think, wow, okay, I get it. It makes sense. So this is why if you have a 10, 20-year period, you want to stay steady in the market, right? And work with someone like Michael, who is partnered with you guys and managing the money, and it's actively managed. You guys are watching it. And what I like about it, I don't have to worry about my IRA and 401k, right? Because you guys are taking care of it. And I know that's a lot of that money I'm not going to need for 20 years. So,
yeah, I mean, you're staying the course, right?
Yeah.
And this shows exactly what the benefits are if you do exactly that. Just stay the course. Don't let all the media and news headlines keep you afraid.
Yeah, I mean, look at the chart, 2008 was between 30 and 40% down.
Yep.
And then you go to the right, 2009, between 20 and 30% gain.
Yeah.
2010 was another, I think, positive year. So then you just start to look at the chart. Those are the opportunities where you can really build some wealth. If you don't already have money invested, those big downturns, if you look at the right-hand side afterwards, that's when the market really takes off.
Well, sure. Look at 2022 over on the left side there. 2022 was down between 10 and 20%. Imagine the people who just didn't panic and pull their money to cash. If they left it in within a year, look at the market the next year, 23, 24, they're really well over 20% gain.
Well, exactly.
Yeah, so this chart is something that I might have blown up and put on my wall because it's just like the last one we looked at. This one is really powerful. And it is my favorite chart until you showed me that one that we looked at, the intra-year down market. Like every year there's going to be a dip, so don't panic. Like illustrates it better than anything I've ever seen.
Yeah, I mean, every year, each line represents a year, and every year there's been a dip, right?
Mm-hmm.
I mean, can you imagine a year that there wasn't some sort of concern? I mean, this year even we had a government shutdown, we had tariffs, we had a number of things, but look at where we are. So each year comes with a lesson learned, and really an opportunity for good investments, right? Investing in good companies, but then investing for the long term, or whatever your time horizon is, but giving you a recipe that's specific to you.
Yeah.
So I hope we spurred some thought, some action, hopefully, where you wanted to get started. If you haven't already put a plan together, or if you had questions about your current portfolio or your current investments, one really cool report that I run, I get really excited about. I don't know if my clients do. It's the Morningstar report. We take your risk analysis. We look at your current investments. Does it match up? Are you taking too much risk, not enough risk? Are you outperforming, underperforming? Right. So I love that report. But if you'd like to have just that report run, let's see, are my current investments matched and aligned to my actual risk tolerance? And if it is, am I outperforming or underperforming? And if not, what else is available? Well, give us a call. Let me run that report for you. 916-469-9016, or go to the website, thematterfinancialgroup.com, and click on the Calendly link and select a time you'd like to meet with us.
All right. Well, great show today. And thanks to our special guest, Ernesto De La Torre.
You got it. Yeah.
And Michael Matter, our host extraordinaire. You guys, I learned a lot today from both of you. Great show talking about where the markets are at and the importance of investing and staying the course. Great show. Great show. And I hope everybody out there has a Merry Christmas and a Happy New Year, right?
Yep. Happy
you too,
holidays.
Tony. And Ernesto, thank you for joining us. And I think, you know what? You passed the test. We'll probably have you on again.
Oh, yeah.
Thanks, everyone. And enjoy the holidays here. Happy New Year.
All right. And that does it for today's episode of the Matter Financial Report with our host, Michael Matter.